slide, monetary policy in Asia Pacific during 2024. And let me start with the first slide. This is Asia manufacturing output. What's happening there? The manufacturing PMI, the Purchasing Manager Index, is a well-known indicator to understand what's happening, especially not in the financial market, but in the real market indicators. So on the left-hand side, as you see, the gray line or the black line covering the technology manufacturing output. The blue one is the overall, and the purple one is non-technological output. Please look at the recent development here. As you see, we have the COVID pandemic. Hang on a sec. I think there's a problem on the slide here. As you see, this small crash is the COVID pandemic crash in the manufacturing output in Asia. Then after the COVID pandemic, all the technological and non-technological overall output of the manufacturing is recovering. But as you see here, the recent changes is approximately flat. So the manufacturing is steepening on the Asian side, Asian manufacturing. Why this is important? Because the Asia is the manufacturing center of the world. China and India is a center for all countries almost until the pandemic. After the pandemic, some countries moved their center to Europe or Eastern Europe to not to centralize all the manufacturing, because especially during the COVID, we've seen that there was a crash in supply chain and nobody can transform their shipments or any order from that or Canada or Europe. For that reason, they moved. But still, India and China is the center of the manufacturing of the world. And today, as you see, manufacturing is still on a stationary outlook. On the right-hand side, as you see, the Asian tigers, the Korea and Taiwan shipments to inventory and profit. You will see here, as you see, this is COVID pandemic. But here, as you see, the last changes, by the way, shipments down relative to inventory levels and shipments up relative to the inventory levels. As you see, shipments decreasing related to the inventory levels. What does this mean? One reason, there is no order from the rest of the world. Second reason, there is no production and the shipment from the Asian tigers and Korea and Taiwan. And if we look at what's happening there, and if we try to understand what can be the basic reason behind those three, let's look at first to China, the motor machine of the world GDP growth and the production center of the world still. They have a race with the India, but still China is the leader of the world economic product. And if you look at the left-hand side chart, this one, please try to understand what this chart showing us. This is directly reflecting the future region, the gross domestic countries. So if you look at I think there is a problem in the action. The screen is freezing. Okay, I think the internet connection is better now. Is it freezing still? If it is, I will close my camera as well. Because camera is decreasing the internet efficiency. Okay, let me close my camera. Let's say.
Seems like the presenter has internet problems. Let's wait for him.
Give me 1 second, please. I'm trying to resolve that connection problem. Is it clear now for my voices?
Yes, now I hear you well.
Perfect, perfect. I reconnect from the screen and I close my camera. As you see here, the China economic snapshot on the left-hand side, and this side, as you see, the contribution to real gross domestic product. What does this mean for us? The gross domestic product for the Chinese economy is this: the investment, consumption, and net export. As you see from the GDP contribution, you can directly understand that what we mean by GDP. GDP is the total output in an economy, and the GDP directly counts the overall economy, consumption, investment, from the expenditure in export minus import, or you can collect the last two as the net export. This is net export, total export minus import. And as we know, the consumption, investment, and government expenditure for the China, and this is showing the overall percentage changes in the Chinese economy. And please try to look at this screen. You see here, the light blue one is the consumption. And for the Chinese economy, during approximately 50 years, let's say the 1980s, and today we have 2040, over approximately 50 years, the consumption is the biggest contribution in the gross domestic product. But now, as we continue and converge to 2020, the contribution of the consumption is approximately less than 2%, here, as you see. But what is important for the Chinese economy? The black bars. Those are the investment cycles.
Sorry, Dogan, you still have the same problem. We can hear you clearly.
Could you hear me now?
Yes, but it's like you're cutting off.
Okay. Give me 1 second. I will connect the computer from the phone, not the main internet distribution. Give me 1 second, please. Could you hear me now?
Yes, let's try it to see if it's working now. Go ahead. Seems like the presenter disconnected. So we can wait for him until now. So let's wait for a little bit.
Hello, the sound is better now.
Yes, a little bit.
Okay, perfect. Let me share my screen again. I think now it is better. Then, as you see here in the bars, what is the contribution of the GDP for the Chinese economy and how they contribute to the gross domestic product? The biggest contribution comes to approximately 2000 from the consumption side. But today, Chinese economy is trying to achieve a conversion cycle. What is meant by the conversion cycle? They are trying to make the Chinese economy a investment-based economy rather than a consumption-based economy. So today, as you see, the investment contribution for the GDP is higher than the contribution of the consumption. But the most dramatic picture here, as you see in the chart, is the orange one, the overall gross domestic product growth. What does this mean? Normally, the Chinese economy in the 1980s growth approximately 10%. In the 1990s crisis, it has decreased, but until here, still it is 7 and 8%. But now, during approximately the last 10 years, Chinese economy is not growing as it is expected. What is the problem here? They are decreasing the growth performance, but they are trying to convert their economic cycle from the consumption-based economy to the investment-based economy. So we can also understand from this picture that China, in a conversion and cycle of the gross domestic product, they are growing less than their potential output, but they are trying to convert their growth dynamics from consumption to the investment. And if we look at the right-hand side, please look at this one. Purchasing Manager Index in the Chinese economy. By the way, when you look at the Purchasing Manager Index in an economy, the 50 is a benchmark. If the Purchasing Manager Index is less than the 50 benchmark level, this means for economy that economy is producing less than its potential. What does this mean? The economy is crashing. Okay, production side is crashing for that economy. The second picture here, what can we see here? Please look at this Purchasing Manager Index. The black one is services. The blue one is manufacturing. As you see in the COVID, services crash higher than the manufacturing index. This is normal because all restaurants, all public services, everything is closed on the street. So services sector is crashing more than manufacturing. But as you see here, the most problematic and dramatic things for the Chinese economy is this one. Here we have higher than the 50 benchmark level. This is good. But for the China, the minimum level or the average is around 52. So we still less than our long-term average levels for the Chinese economy, Purchasing Manager Index. And please look at now, if the China is trying to convert the production cycle from the consumption-based economy to the investment-based economy, this is fixed asset investment by enterprise and ownership. This is year to date and change per year, year-over-year change. This black line is aggregate changes, and this purple one is state-owned enterprise. As you know, China is a communist economy, and they are still producing lots of things with a state-based economy. And private sector here, as you see, even less than zero or around zero. And the state-owned enterprises is around normally, if we look at approximately 10 years, it is around 10%, even higher than 10%. But today, it is 8%. And the cycle here, as you see, state-owned enterprises, is a decreasing cycle. What does this mean? Even investment is decreasing in the Chinese economy. Consumption is decreasing, even investment. What does this mean? The overall economic output, the gross domestic output in Chinese economy is decreasing. And this is crashing for the rest of the world. Because if the China is not growing, the rest of the world is almost a recessionary cycle. China demand is important. China production is important. China export is important. And on the right-hand side, as you see, fixed asset investment for the major industries. This is again year-over-year change. And this is real estate, manufacturing, and infrastructure for the overall economy. And here, the black one is real estate. What is the most dramatic thing in China's economy? If you write it is in Google, the real estate. The real estate housing market is a crashing cycle in China. Lots of housing market is dropping and lots of house prices decreasing. So if you look at and focus on the black line here is approximately 10%. During the COVID, it is decreasing. Then after the COVID tantrum here, as you see, it is recovering. But now, please look at this cycle. The black line is almost decreasing to the minus 10%. This is a shocking effect for the Chinese economy because housing market, real estate market is really, really important for the Chinese production and growth. But manufacturing and infrastructure is still around 10%. This is a good news for the rest of the world. But if the real estate market, if the housing market cannot be recovered to the even 0%, this means that steel production, bracket production, what is the input for the housing market will decrease. The price of those things, steel, iron, bracket, all those things can decrease in the next couple of years because the China's real estate and housing market demand decreasing for the rest of the world. And let's look at in China the inflation cycle. What's happening in the inflation and consumer prices of the Chinese economy? As you see here, consumer price inflation is around approximately 1% and 2%. This is the target of the Central Bank of China, People Bank of China. This black line is headline. This black line is headline inflation, and this light blue one is the core inflation for the Chinese economy. But what is important? The benchmark and the target for the People Bank of China is around 2%. But what's happening here? Both the headline and the core inflation is decreasing, less than the benchmark level of the People Bank of China. So what we can call here today, whether the China is in recession or not, because after the COVID, United States Federal Reserve, European Central Bank, Bank of Canada, Bank of England, the best well-known central banks are increasing their interest rate because of the inflation. But two central banks are following another direction. They make an implementation of counter-cyclical monetary policy. Those are China and Japan. Because the inflation cycle is in another direction for those countries. For China, let's focus on China. The inflation is less than the 2% of People Bank of China benchmark level. And today, lots of state-owned enterprises and banking liquidation injected to increase the prices in China. Please focus on this detail. In United States, in Europe, in Canada, in United Kingdom, the prices is going up. But in China, it is going down. So state is intervening to the market to increase the price level. Even the monetary policy is adjusted according to the inflation output. And on the right-hand side, the most important things, because China, yes, they are consuming, but China is producing for the rest of the world. So producing prices is really, really important for the China. This is China, the black one is producer price index, and this light blue one is the US import price index. Please look at this dashed line. On the right-hand side, you see the US import price index, and on the left-hand side, producer price for the China. Producer price from 15% decreased to minus 5% in China today. This is a crashing, shocking news for the rest of the world. Producing prices is decreasing. What does this mean? If the producing supply side inflationary cost is decreasing for the rest of the world, in the economy, the consumer price index will also decrease in the next couple of months. So we are calling this the transformation of the producing price to the consumer price. But as you see, the producer price index decreasing in the Chinese economy. What can we conclude from this development? This directly giving a signal for us that the producing price is decreasing, and the next couple of months, consumer price will also decrease in the Chinese economy. And now, what is the most important, and what is trying to government authorities doing to take a measure for the decreasing prices in China? This is monetary policy and the credit growth in China. The left-hand side, please look at this left-hand side chart. The purple one is the loan prime rate for the 1 year. This is 1 year loan rate. This is interbank repo rate, repurchasing operation rate, normal policy rate for the People Bank of China. This is 1 week repo rate. The medium-term lending facility for the 1 year, this black line, and the loan prime rate for the 5 year, the long-term loan. And as you see, all of them is decreasing. The most important thing is all of them is decreasing for the China. Normally, during the COVID pandemic and after the COVID pandemic, lots of interest rate in most of the world economy is increasing. But in China, because the inflationary outlook is decreasing, they are decreasing the interest rate as well to trigger the demand in the economy, because there is no demand. Nobody wants to buy anything. Nobody wants to build something. Nobody wants to produce something and consume something. So to trigger the economic demand in the overall economy, they are decreasing the interest rate. And on the right-hand side, please look at the credit impulse, credit growth for the Chinese economy. This is percentage of nominal GDP, year-over-year change. Why the credit is important? In an economy, if there is no money, if there is no credit growth, you cannot produce anything, overall growth or gross domestic product increase. So please look at this cycle. This is After the COVID, there is huge credit impulse in the economy. Credit growth is approximately 10%. After the COVID, as the inflation is increasing, the credit growth is -8. But now, what is important for us? Please don't see this slide because this is after the crisis period, up and down. But what is the normal cycle here? But the normal cycle for the black one, aggregate financing, is minus. So there is no increase in the credit in the market. There is no money. There is no sufficient economic cycle to increase the demand and overall economic output. And this is China exchange rate. As we explained a few minutes ago, China is an communist economy, and their exchange rate is not a floating, free, flexible exchange rate. It is not flexible. It is crawling peg. What we mean by crawling peg? The People Bank of China control how much the Chinese yuan can depreciate or appreciate against the United States dollar. They are controlling the exchange rate market. Okay, they are crawling peg, meaning they are moving in a band, up and down band. Let's say 2% up or 2% down. And this one is, if going up, stronger Chinese yuan, and if it is going down, weaker Chinese yuan. I also want to explain a point here. This point is this: currency war. Currency war started in 2010 between the United States and China, because China is an exporting country for the rest of the world. And if you are exporting something, you want your own currency weaker, because you will collect foreign currency from the rest of the world, because you are selling the product. You will bring the United States dollar, you will bring the euro to your economy. And if your currency is stronger, you will lose this war. So you want a weaker Chinese yuan, but you want stronger United States, because you are collecting, you are inflowing the United States dollar because of your export sales to the rest of the world. So as you see here, the index, this is Chinese yuan index, and this is USD China, inverted currency cycle. And please look at this one. As you see, the Chinese yuan is still weaker. And Chinese economy, please look at here. Please look at here. Normally, as you see here, $1 is 6.3 Chinese yuan. But now, $1 is 7.3 Chinese yuan, meaning that approximately during 2 years, 15% of depreciation in the Chinese yuan, from 6 to 7. Approximately 15% of depreciation for the Chinese yuan. And now, let's look at what is happening, another giant in the Chinese economy after the China, the Asian economy, the India, which is trying to capture the leading role from the China for the production economy. This is component contribution to the GDP. And as you see here again, investment, private consumption, government consumption, net export, others, and GDP. And for the Indian economy, the real GDP growth, 10-year average is 6%. What is dramatic for us? For the China, normally the GDP is around 6, 7, but now it is less than 5. Now, the India taking this role as the GDP growth and motor machine of the world economy. The 10-year average is 6%, and now it is 7.8%. The Indian economy is growing. So we can conclude from here that India can take the role for the production center of the world from the China. Because they are growing, they are increasing their manufacturing, they are increasing their services, they are increasing their production. So the next step will be the India can take the role of the leadership of the world manufacturing from China. And on the right-hand side, government capital spending, how the government making investment in capital structure. This is state government and federal government, and the total is the black one. As you see, government is also supporting for the capital and investment in the Chinese economy. In the 2020, it is approximately 4% injection and support from the government for the Indian economy, but now it is approximately 6.5. A huge support from the Indian economy to become the world center of the production and manufacturing against the China. They are taking the role. They are achieving this goal. And the Japan, what's starting the most dramatic changes during the 5th August, the Japan economic snapshot. This is Japan economy, and what's happening here, component of the GDP, the contribution to GDP, as you see, again, consumption, private investment, public investment, government expenditure, and net export. What is dramatic here for the Japan economy? Please skip this side. This is the crisis side. If you focus on this side, the consumption contribution is almost positive, as you see here. Look at the black box. Consumption contribution is positive for the real GDP growth. But now, consumption is decreasing. So there is a decreasing cycle in the consumption. But what is increasing there? The net export again. Net export is the growth dynamics, motor dynamics of the GDP growth in the China economy, because China is one of the biggest exporter of the world economy. And the total GDP is minus, still in a recession for the Chinese economy. But after this cycle, you will see in the next couple of slides that after this decrease in consumption, decrease in interest rate, after the 20 years, China economy is efficiently increase the inflation, because the rest of the world is trying to decrease the inflation, but China trying to create an inflation in their economy, because there is no inflation in China during 20 years. No inflation. Prices are going down or almost around the zero. But now they achieved to increase the inflation and price level. So to counterfight with the inflation level, they are increasing the interest rate for the long run of the achieving of the economic output. And as you see here on the right-hand side, this is showing Japan core inflation and wage growth. The nominal wage growth is the blue line, and the inflation, the core inflation, this is X food and energy. If we are excluding food and energy prices from the headline inflation, we will achieve the core inflation level. And look at this line. Core inflation is dramatically increasing in the Japan economy. Please look at here. From minus to the 4%, the core inflation is increasing, but the wage growth is less than that. So the purchasing power of the household is decreasing because you don't have enough wage to get the same basket with the previous. You don't have enough money because your wage is growing around 1%, but the prices of the food and other things around 4%. Your purchasing power is decreasing. So to fight with this inflationary effect, the Japan economy is increasing the interest rate to fight with the inflation in the Japan. And please look at the Japan monetary policy and the currency. The K interest rate on the left-hand side, as you see. The black one is Japanese policy rate. Please look at this side. From 2013 to 16, during 3 years, only almost 0.1%. Then decrease in the interest rate. And during 8 years, from 1916 till now, approximately 8 years, minus 0.1% interest rate, minus interest rate in Japanese economy during approximately 10 years. But now, please look at this mouse. Here, there's an increase in the interest rate. Why? Because the Japanese government bond yield increasing. Why? Because if the inflation expectation for the next year increasing, bond yield will increase as well. If the inflation expectation for the next year increasing, then the bond yield will increase as well. Follow, because you will lose money because of the inflation. So if you are buying bond, the price of bond should be higher. Otherwise, you will lose against the inflation, right? So because of the inflation expectation, Japanese central bank increasing the interest rate to decrease the inflation. And please look at the USD Japanese interest rate spread and the USD Japanese yen parity. This one is the exchange rate, and this one is the interest rate spread between Japanese bond and United States bond. The left-hand side, the black line, showing the 10-year spread for the bond market, and the right-hand side showing the exchange rate market for the Japanese yen. Please look at this one. The blue line, here as you see, now here. But after the crisis of the August, the Japanese yen parity decreased approximately 140. What does this mean? Approximately 15% decrease in one day in the USD Japanese yen parity, because there will be no cheaper Japanese yen in the economy. The cost of Japanese yen will increase. So they are gaining strength and appreciation against United States dollar. And the spread for the 10-year government bond, as you see, United States Treasury bond yield minus Japanese government bond yield, it is increasing, as you see. And they are directly correlated. They are up and down in a cyclical and correlated frame. And if we look at the Asia Pacific inflation target and central bank operation for the economies, what is happening there for the government and what are they trying to implement in their economies? Please look at the explanation here. The black one is inflation target range. The blue one is inflation target or midpoint. The purple one is current inflation. And the green one is inflation 6 months ago. Please look at for the China. What you can see, inflation 6 months ago is here. But now, because the government take measure, inflation is positive. But inflation target is here. So it is not enough for the Chinese economy. They will try to still support the government and the private sector in the economy to create the inflation, because it is really far away for the Chinese target. It is around 3%, but the current inflation is almost 0.3, nothing. And for the Thailand, please look at this one. They are trying to also create inflation. The current inflation is here and the target is here, meaning that Thailand is almost achieved their target. And for the Malaysia as well, 2.5% target, but the current inflation is almost 2%. So it is good. And the current inflation for the United Kingdom is almost same with the inflation target. Current inflation is 2% and the target is 2%. So England, Bank of England, is achieved its inflation target for their long-term growth. And the Taiwan, also same, 2.2% current inflation and 2% inflation target. Indonesia, almost same. What is important for us? The Eurozone. Please look at here, because Eurozone is trying to decrease the inflation. Inflation target is 2% and the current inflation is 2.6%. So the next couple of months, if the inflation does not converge to 2% target, the Eurozone, the European Central Bank, will take additional measures to decrease the inflation output and outlook in the economy. And please look at the United States. The target is here, 2%, but the current inflation is 3.3. But the Federal Reserve is expecting until the end of this year, the inflation will converge 2.5%, and in the mid-2025, the inflation target will be almost exactly same with the current inflation level. And the Philippines and India, please look at these Asian tigers as well. Target is here, and the current inflation rate is here. So they have some ways to decrease the inflation additionally. For the same for the India as well. The inflation target is 4%, but the current inflation is approximately 4.7%, meaning that the India still have some ways to decrease the inflation. So they are not changing their monetary policy outlook. They are not adding additional measures or decreasing or increasing the interest rate because they made some monetary policy implementation and they are waiting the lag effect of their monetary policy measures that is taken approximately 2 years ago. And the last chart for my side, this is global central bank policy rate changes. And please look at this black and gray line. These bars are developed market and these are the emerging market. As you see, during the global financial crisis 2008, all central banks in emerging and developed markets decreased their interest rate. And after the global financial crisis, until the COVID crisis, some increasing, some decreasing. The developed market almost around zero, and the emerging market decreasing their interest rate because they achieve their inflation target. But during COVID crisis, as you see, most of the central banks in the world decreased their interest rate. They made rate cuts. But after the COVID, as you see, almost all of the world increased their interest rate to fight with the inflation. But now, what is happening in the world today, because the inflation is almost reached their peak levels, and now the inflation outlook, except China and Japan, is decreasing. And for that reason, almost all economies decreasing their interest rate, emerging market and developed market as well. And what is the forecasted change in central bank policy rate for the rest of the world? This is Taiwan, Japan, China, Thailand, Malaysia, South Korea, Europe, Australia, United Kingdom, United States, Indonesia, India, and Philippines. As you see, the highest level for the Philippines and the lowest level almost Taiwan. As you see, this blue line is current interest rate, and the purple one is the forecasted range. So if we look at the biggest economies like the United States here, the current is approximately 5%, but the forecast rate by the end of the year will be less than it. So if the current rate, as you see, these rectangles is up and if the bar is down, meaning that the central bank will decrease the interest rate until the end of the year. And almost for all economies, except China. Please look at the China. Rectangle is below the line, but other economies, rectangle is upper than the line. So except the China and the Japan, almost all economies will decrease their interest rate until the end of the year because they achieve their inflation target. And to fight with the inflation, there is no additional need to decrease the interest rate. So this is